Welcome to Web3 Watchdogs, the podcast that takes a deep dive into the world of Web3 security, compliance, and risk. Join Michael Pearl as he interviews executives from across the Web3 industry to uncover the challenges and opportunities of this rapidly evolving space. Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.
Hello, everyone, and welcome to the Web3 Watchdogs, the podcast that focuses on everything security, compliance, fraud, scams, risk, and anything else that is interesting in the Web3 space. Before we dive in, please remember to subscribe, to rate us 5 stars, to recommend us to your friends, and if you have anything that you would like to ask or comment on, please comment on Spotify and on YouTube. And today we have a very special guest, Natalia Latka. Natalia is a lawyer who is now also studying in Harvard. She corrected me that she hasn't finished yet, but good luck on that one. She currently serves as the Director of Public Policy and Regulatory Affairs at Merkle Science. She is also the owner of Crypto Regulatory Compliance Advisory. She is also the co-founder of CARCI, which is the Crypto Asset Regulation and Compliance Institute. Previously to that, she managed crypto asset compliance and regulatory research at TRM Labs. And she was also a compliance officer at UBS. That's a long one, huh, Natalia?
Yeah, but that's correct. It's been a long journey, but very exciting one as well.
Nice. Welcome to the show.
Thank you for having me. I'm really glad I was invited, so really excited to get started.
Perfect. So for those of you who don't know Natalia, she's very active on LinkedIn, very active in the compliance and the fraud and the regulatory groups. I really like reading what she writes. And Natalia, I wanted to ask you about your background. So basically, you have a very impressive background, as I just reiterated. You are an EU qualified lawyer. You specialize in crypto regulation. What led you to focus on this issue? And more specifically, what led you to focus on this issue in the blockchain space?
Yeah, well, honestly, when I was studying law, which was a few years ago now, I didn't find it all that exciting because when you think about regulations, most of the legal frameworks that we have, they are already well established. There is also a solid practice in place. And let's be honest, the court rulings are fairly predictable in most of the areas. So there wasn't much room for surprises, really. And of course, regulations evolve, they get modified or even replaced entirely, and you have to stay up to date with that. But that's just part of the legal job, isn't it? And then in 2014, I came across crypto, and it was thanks to my friends from my hometown who set up one of the first exchanges here in Eastern Europe. And at first, I didn't fully understand what it was, what crypto was. There wasn't much legal analysis on it at the time or media coverage. And when I asked my lead professor at the time, he didn't have a clue either. And that's when I thought, actually, maybe this is something worth looking into. And by 2017, my initial instinct was actually confirmed because prices were skyrocketing and suddenly everyone was paying attention and everyone was watching that space. Regulators, tax authorities, consumers, you name it, everyone was trying to understand what crypto actually was. And I think that, with all that uncertainty, unpredictability, and lack of legal rules in place, I realized that there was a real potential behind it. And I just realized I may want to be part of that sector. I want to specialize in it. It just felt way more dynamic and interesting than more traditional legal fields. And honestly, I wasn't exactly wrong because look at where we are now, and it's just same dynamic as it was before.
Yeah, as a lawyer, I can definitely agree. This field is so trailblazing and interesting and very dynamic, and definitely the place to be versus the more boring fields that are, as you said, everything has already been discussed and all the court rulings have already been decided. So definitely agree with that. Can you zoom in on what you're doing at Merkle, in general, what Merkle is doing, and more specifically, your role? What's your day to day look like?
Yeah, of course. So Merkle Science is a blockchain analytics firm. So to no one's surprise, we offer compliance solutions in the crypto space. And I'm a policy and regulatory affairs director. So basically, I handle everything related to crypto regulation. So I guess you could say I'm a bit of all-rounder in this space. It's policy development, regulatory analysis, responding to consultations, maybe also engaging with industry association, thought leadership, all of it. But a big part of my role is engaging with regulators, building relationships with them, and just staying on top of all the regulatory changes and challenges that come with them. But it's not just about tracking these updates, because at my work, I also have to break down these regulations and turn them into actionable items. Because at the end of the day, here at Merkle Science, we are providing compliance solutions. So everything we do has to be actually grounded in the regulation, because products we create are naturally an outcome of regulatory analysis that we conduct in the first place. So I guess you can say that my job involves looking at what's changed and figuring out if there are any new challenges and if there is a solution we can develop to help our clients stay compliant. So it's about making sense of the rules and translating them into something practical, and just making sure that customers we have understand these rules and they also can integrate solutions within their internal processes.
Yeah, I can imagine it's a very challenging task. We talked about the dynamics of this field, and at the end of the day, when you have the regulatory framework, you have a few sentences that say what you're expected to do, but nobody really understands how it looks like on the practical level. And then all the compliance teams try to figure out what to do. So, following that, I read your latest guide on MICA. And I think 2 days ago, I got in my inbox your guide on the UK regulations, which was very interesting.
Thank you.
One sentence there caught my eye, and I wanted to clarify it. So you're saying that the latest guide states that monitoring token ecosystems is essential to meet regulatory expectations. Can you elaborate on that? What does it mean to monitor the token ecosystems? How do you actually do that?
Sure. Well, thanks for reading in the first place. But at first, I think that we were mainly focused on analyzing individual transactions or just assessing the risk tied to a specific wallet or a specific customer or entity. But I guess that over time, we just realized that these risk assessments are just as important when looking at the broader token ecosystem. So it's basically a holistic 360-degree dashboard that gives token issuers a much deeper understanding of what's happening with their own token. I think that, you can think about it as their own surveillance tool. It helps them understand their own ecosystem, track activity across their network, and evaluate different interactions that are happening. So what we did at Merkle Science was bring together off-chain metrics and on-chain data. On the off-chain side, this includes details about the issuers, and these details are not related to transactional activity. So this is data around the regulatory status, licenses they may have, information on white paper, if available, reserve assets, redemption rules, you name it. And then we take all that off-chain information and we combine that with on-chain analytics. So things like transaction volumes, user interactions, exposure to illicit activity, and movement patterns. So what happens when you actually put this together is you get a really powerful view of the token's activity. And now, why this is important? I think it's important to note here that there are two sides to it. One would be the business side, and another would be the regulatory side. Because from a business perspective, this is incredibly useful. Issuers can track how their token is being used, see adoption across different demographics, and also understand where it's being used geographically. They can also analyze its connections to different infrastructures, whether it's DeFi or traditional payment systems, and they can even compare it to different competing tokens. So I think that all of this helps them make smarter, better informed business decisions, maybe even spot new opportunities, expand to new markets, and scale their operations. So it's about knowing what's happening, how it's happening, and whether they can capitalize in certain areas. But At the end of the day, token ecosystem monitoring isn't just about tracking growth. It's about protecting this ecosystem. It's preventing its misuse. It's just making sure that everything really stays aligned with your business goals, with the intended use, and also regulatory requirements. Because issuers have a big responsibility to oversee how their token is being used. Take MiCAR as an example. So, if a stablecoin has a significant market cap and significant transactional volume, and it becomes widely adopted and also deeply integrated with other systems, it could be classified as significant. And what it means, it's stricter requirements around reserve of assets or liquidity management. So I guess that monitoring the threshold where a token shifts from being just a stablecoin to something systemic is actually very critical. And it will not be surprise to anyone that regulators also expect issuers to actively track and report different metrics on a regular basis. But again, it's not just about the issuers who benefit from this, because when you think about platforms that list these tokens, whether proactively or at the issuer's own request, they can also use this insight to assess whether the token is suitable for their platform. And in this way, they can also, manage their own risk exposure and just make sure that the token they admit to trading meets all the criteria in the listing policy.
Yeah, it's very interesting. Obviously, managing a token as an issuer is a very challenging thing. At the end of the day, the blockchain is decentralized, but the token issuers have lots of powers. Depends on the type of contract that they built at the time that they launched the token. But in principle, they can freeze tokens, they can change different balances and things of that sort. And we saw that with the USDT, with Tether, of course. But definitely this is something that is necessary for them to understand where they stand in terms of compliance and in terms of the exposure of their project. I wanted to ask you, one of the least known regulations is DORA. DORA basically has went into effect concurrently with the MICA. On the practical level, what does it mean for the crypto companies? What do they need to adhere to?
Well, so I wouldn't call myself a DORA expert because that's completely different field, but it's very clear to us that DORA applies to crypto firms now. And I think that in general, policymakers globally, not just here in the EU, they recognize that cybersecurity risk in our space are as serious, if not even more, than in traditional finance. Because when we look at all these high profile hacks, exchange collapses, protocol exploits, and all the operational failures we've seen so far, it's really no surprise that regulators wanted to make sure that these providers meet the same or at least similar standards as banks and other financial institutions. But coming back to your question, what does that actually mean? Well, DORA introduces a whole new layer of regulatory requirements around ICT risk management. And the goal actually is quite simple, is to make sure that firms can not only prevent and withstand the cyber attacks, but also respond to them quickly and minimize the damage if they actually get hacked. But it's not just about adding a few policies here and there and calling it a day, because just like MiCAR, it's a really massive operational and financial burden for many crypto firms. And in all honesty, I think that that's probably one of the reasons, out of many reasons really, we are seeing so much consolidation in the EU market, because smaller firms are merging with bigger ones or they are getting acquired just to keep up with compliance requirements and with the cost associated with it. Because MiCAR is costly already, but it doesn't exist in a vacuum, right? It still works alongside DORA, it works alongside MiFID, PSD, EMD, travel rule, AML compliance, and it all adds up. And it's not just about compliance requirements, it's also about the cost associated with it. And maybe last thing I would say here, because it's actually something that we are looking into right now, is that DORA also means that these crypto firms now have to assess the risk associated with third parties, such as vendors like ourselves, including blockchain analytics, because it's not just about their own security anymore. It's just about making sure that everyone else, including vendors in their supply chain, meets the same high standards as they do.
Yeah, that's definitely something that I can relate to. Just, to give you some figures, according to our data from Cybers, $2.3 billion were stolen last year. Definitely cyber attacks of all sorts are a big headache for those companies. And at the end of the day, it's the role of the regulators to protect the investors, right? And that's no surprise for them to add a regulatory framework that also relates to cyber attacks and the defenses and protections that you need to have to prevent them. And it's a very good point with respect to how you mitigate that. After you were hacked, can you trace the funds? Can you stop the theft from happening? Because oftentimes it doesn't happen in one transaction, it's a process. And by the way, oftentimes hackers go back to the crime scene and steal again. We saw that with quite a few protocols that were hacked. So all these things are something that right now the EU regulated companies need to think of, and I think it's a very healthy process. So I want to switch gears and to talk about something that you also talked about extensively, which is unbanking. And from my experience with our clients, we see basically, let's say, three different ways of unbanking. First is the retail unbanking, right? If I'm a user and I'm interacting with the cryptocurrency companies and I'm getting funds that originated from crypto, I can be unbanked. But I think the more meaningful problem here is on the company level, right? On the enterprise level. And here we see two different categories. One is companies not being able to receive funds from their users, either because they were flagged as facilitating fraud or illicit funds and so on, or companies that are losing their bank account altogether and cannot even get banking services in general. So, can you share some of your own experience with your clients and what you see in the industry right now with that respect? Because I know it's very concerning for the industry.
Yeah, I think that the environment has been really hostile for crypto businesses over the past few years, and the banking is definitely one of the serious issues we have. And it's actually a bit of a paradox when you think about it, because on one hand, we allow crypto activity to happen, we even regulate it, and we even register businesses, we give them licenses. But on the other hand, if banks keep cutting them off, we are basically imposing some sort of a silent ban on their operations. Because let's be honest, no business can function properly if it's constantly running into operational problems like this. And this is one of the basic services they are looking to have. So, now to be fair, there are different reasons behind it, and not all of them are completely unreasonable. Some banks, obviously, they just don't feel comfortable with the sector. It's completely outside their risk appetite, and they are not willing or they are just not ready to build the teams and necessary expertise, as well as tools needed to properly assess these risks. And I think that that's a real shame because, ironically, crypto transactions provide way more transparency than traditional finance. And yeah, we have these tools at our disposals, like Merkle Science tools. So I think that banks do have tools at their disposal to assess this risk properly, but they don't for certain reasons. And of course, there are cases where a bank should reject a crypto business based on a proper risk assessment, and that's completely fair because no institution should be forced to take on risk that is beyond what they can tolerate. But unfortunately, from what I've seen so far, a lot of these decisions aren't actually based on a risk analysis. Instead, it's just sort of a blanket approach where anything remotely crypto related gets blocked and it's just labeled as a high risk by default. And that's actually quite interesting because, we always say that, hey, risk management isn't one size fits all. Yet when it comes to crypto, we act like it's high risk fits all, which is obviously not true. Although EUSMA would probably disagree with me on that given the recent supervisory brief, but this is a completely different story. But what we need is a shift in perspective where instead of trying to de-risk the sector at all costs, we are actually implementing a risk-based approach as we should have done in the first place. But going back to my earlier point, I think that it's general reluctance and misunderstanding of the space because in certain cases it goes even further than that because I've personally run into situations where banks flag anything with the word crypto in it, even when the actual business has nothing to do with crypto services. So my own legal office has a crypto in name. And I really had to do a lot of explaining to my bank that I wasn't providing crypto services, but just the name itself was enough to trigger that extra scrutiny. Sadly, I've also seen so many cases where regulated firms not the firms that are just AML registered, but firms that have a proper authorization, they still struggle to get banking access. So even if you have email license or a banking charter license, they still face these problems, while a traditional company offering a traditional service that also has email license can get a bank account. Meanwhile, their crypto counterpart can't do it. And I think that that's one of the things that Anchorage highlighted in recent hearing in the US. And I also seen similar stories here in the UK. One of the example being Gemini, that also has email license and really struggled to secure this banking in the UK.
Yeah, I think that banks that are crypto skeptic in general, I think that there's nothing you can do about it. And at the end of the day, as you said, it's their right to onboard and offboard companies as per their risk types. But obviously, the banks that are more kind of leaning towards crypto companies, I guess there it helps if a company is having the proper compliance and fraud prevention tools and cybersecurity tools and so on, so that the company can appear as a lower risk for the bank, right?
100%, because obviously it's all about risk-based approach and conducting this due diligence on crypto firms that are becoming your counterparty. So if they have a proper policies and procedures in place that are comparable to what we have in banking, I think that this should be based on this due diligence outcome where we see that this specific company is actually compliant with the regulation in similar way we are. Why would we deny banking services? Because it may be regulated in a similar way we are. They may have similar policies, procedures we do, and they may be also leveraging the transparency that blockchain has. So in these cases, I would say we need to look into what the company actually does, because just because it provides crypto services, it doesn't mean that they are a high risk company by default. Yes, maybe the business services themselves are particularly high risk because we always say it's vulnerable to money laundering, which I don't agree completely with. But just because they engage in certain business, it doesn't mean that they are not compliant, and they can prove it in certain ways.
Yeah, I totally agree. So speaking of remaining compliant, one of the biggest headaches right now that companies are facing is financial crime, and that is also on the rise. And by the way, according to our numbers that were presented from 2024, the figures actually exceeded the ones of crypto hacks. So basically, right now, fraud is a much bigger problem, and you have more as a user. There's much bigger chance of you losing your money due to fraud rather than to hacks. So there are different claims about the magnitude of this problem, and obviously pig butchering being the most prevalent type of attack that exists right now for crypto fraud. So what can you tell us about this and how companies are dealing with it right now? Because it seems like they're lacking the proper tools to actually deal with pig butchering and these sophisticated networks.
Well, I think that we are really barely scratching the surface, when it comes to fraud cases. It's kind of like with ransomware. There is just not enough data, and there are a lot of reasons for that because, some victims just feel ashamed and don't want to share their story because it's not exactly something you would want everyone to know. And coming forward takes a lot, and for some, it's just too difficult. And others, they just don't bother reporting because they don't believe they will ever get their money back. They lost faith in the system. They don't believe in law enforcement and asset recovery, which is the problem on its own. And I think that unfortunately right now, all we can do, the best we can do, I'm not saying from a business perspective, but as a society, is to focus on education and raising awareness because prevention is always better than scrambling to fix the outcome, right? It's always easier to manage the outcome before it happens. Because even with the schemes like APP fraud reimbursement programs, victims are not always getting reimbursed because it's not as simple as everyone thinks that you just file a claim and the money is back. No. Because if the provider can prove the victim was negligent, meaning they should have known that it was a scam, they may not get their money back at all. But I think that it's important to understand how this crime actually happens because this isn't just about individual scams. It's about disrupting transnational fraud syndicates because if we look at the cases, most of these cases aren't just one-off scams pulled by a lone fraudster looking for a quick cash. Obviously, it does happen. Yes, it does. But in most of the cases, these are well-organized criminal networks running professional fraud centers like the one in South Asia. And if you follow Erin West on LinkedIn, you will probably know all about it because she's really good at sharing insights about it. But what we know is that this professional, fraud centers thrive, and they thrive for many reasons, whether it's corruption, weak law enforcement, lack of resources, lack of international collaboration. So it all just makes it possible for them to operate in this region. So if you really want to change something, it's not just about responding to fraud cases one by one and having this preventive measures in place, which are the fancy, sophisticated systems we can implement. It's about going after the structural problems that allow these networks to operate in the first place. Obviously, as a business, we can still set up new platforms, new tools that can help us identify fraud when it's happening. But in all honesty, we can't always tell that the fraud is happening because some schemes are more sophisticated than the others. So I think that instead of trying to sort the fraud problem at the company level, it's worth looking into why there's potential for these transnational syndicates to operate.
I think that you stated it correctly. The fact that most victims do not complain, and that's something that we're hearing from exchanges that we're working with. And it's interesting to see when we uncover the magnitude of pig butchering that affected a specific exchange, and then they go back and they compare it to their clients, and they see that the majority of those clients haven't complained. And when they want to reassure themselves, and they want to validate that indeed it was a pig butchering scam, they go to those clients and they talk to them and they email them, and then they find out, that they have been scammed for tens of thousands of dollars, and they haven't complained. So for that matter, I totally agree that education is important. I totally agree that the law enforcement needs to do more, but good luck with that because it's really hard to track those syndicates, and some of them are located in companies that have no extradition, and it's really hard to do anything about it. So definitely, I think that on-chain methods of discovering those destination wallets is a good solution, because at the end of the day, if money is not being sent, or if the user, the victim, is being warned that you're not conversing
Mhm.
a beautiful lady in the Netherlands, you're in fact talking to somebody at a call center in Thailand, then that's probably the best way to stop it, when you know that this wallet is indeed a wallet that is affiliated with the pig butchery network, and you shouldn't send the money to this wallet in the first place. But yeah, I guess it is yet to be seen, right?
Yeah, that's correct. And the problem is that we don't always have this attribution in place because they also rotate their hot wallet addresses from one day to another. So sometimes we can flag this wallet address, just after the fact, after we already discovered this facilitated a scam. So it's quite tricky for some systems to flag it before it happens.
Yeah. You can flag it before it happens, and that's actually something that is doable. But I agree with you that it's a challenge, both technologically and conceptually, to understand which wallets are which. But there are definitely ways to do it and to prevent it beforehand. But just to follow up on what you said with respect to regulation, so you mentioned the APP fraud regulation by the FCA in the United Kingdom. And if I'm not wrong, the SRF regulation in Singapore, which is different but also bears quite a big resemblance. And there's the latest proposal by the Consumer Bureau, by the CFPB in the US, which has not been finalized yet, but they are also offering something quite similar with respect to reimbursing victims after suffering a hack or fraud and so on. Do you think that regulators globally are becoming more aware and are putting more liability on the platforms, primarily PSPs, but later on exchanges as well?
Well, I think that over the past year or two, we've seen a really clear shift towards stronger consumer protection measure, and whether it's in traditional finance, traditional payments, or even crypto. So it's not entirely surprising that regulators are looking to raise that bar and in some cases even compensate for losses. And that's obviously not a bad thing for customers, but at the same time, we have to be realistic because no fraud detection system is perfect and no system detection is bulletproof. Because some fraud methods, again, are extremely sophisticated, and even with the best preventive measures in place, scams are still going to happen. And the truth is, we won't always recognize fraud when it's happening. Yes, maybe 90%, 99% we can do it, but there's always this 1%. And sure, if there is a sudden spike in transaction activity or, I don't know, unusually large transfers, that should definitely raise, red flags. But there are plenty of cases where everything may look completely normal, both in behavior and transactional patterns. So it makes it very hard to detect. And I think it's just important to have this nuanced approach to authorize payment fraud when setting these regulatory expectations for firms, because there has to be some sort of balance. Like, don't get me wrong, consumer protection is absolutely critical, and it's good to have these measures in place. But if financial institutions or other institutions are forced to take on all the liability without any conditions, there is also a risk that customers won't take enough responsibility for their own actions because they know they are covered in any case. So at the end of the day, if someone was simply negligent and ignored very obvious warning signs, also coming from the institution that is sending the funds, should they really be fully reimbursed? Because if they willingly authorize a payment to a scam, despite multiple red flags and warnings from the institution, that's a very different situation from someone that was generally tricked into it. And on top of that, we also have to consider, the unintended consequences, because some people may actually try to abuse these protections for their own benefit. Or worse, we can also see new types of fraud being emerging, specifically to, exploit these unconditional protection measures.
Yeah, I totally agree with that. At the end of the day, the platform needs to do what they see fit, right? Because some platforms that we're working with, they're just issuing warnings just to warn the client beforehand. Some of them are blocking those addresses altogether. And it very much depends on the policy of the platform and how proactive it wants to be about fraud prevention versus the user experience, right? Because it's always a balance between the two, and there's a tension between the two. But I wanted to ask you about the other side of the coin. So at the post-mortem level, right, after the funds have been stolen, they're being funneled through multiple wallets and dexes and maybe even mixers. And at the end of the day, they land usually at a centralized exchange. Now, if you read the books and if you read the articles, usually they tell you it's some shady exchange in Southeast Asia, but you would be surprised how many Western regulated exchanges are receiving those funds and not doing the proper due diligence to make sure that these funds do not originate from scams and hacks and so on. So, what can you tell us about the practices that exchanges have or should have with respect to receiving funds and screening them?
Well, obviously, incorporating a right blockchain analytics tool in combination with a fraud prevention system is a way here, because these traditional methods that we have in traditional finance are simply not enough when it comes to crypto. And I think that, again, we do have tools at our disposal, as you mentioned before, that can flag this specific activity. And I think that it's really important to incorporate them from the very beginning, because we have this transparency, we have possibility to link these real world entities and attribute these addresses. I know it doesn't happen in every single case, because there are also attribution issues and challenges in the crypto space that we still have to overcome. But in many scenarios, we are able to pinpoint these real world entities, or at least aggregate the risk level for specific transaction or wallet. So obviously it's not surprised that we should be simply integrating these solutions. But also, I guess that we just have to understand as well how the criminals are operating, how they think, because the key to tackling all this issue is actually spotting the red flags. But to know what the red flags are, you actually have to understand the crime itself. You need to understand how these individuals or syndicates are thinking. And then you need to translate these insights into how crypto can be used. Because at the end of the day, crypto is just an enabler like any other device, whether it's just internet, whether it's cash. So what we have to do is understand how crypto can be used specifically, how criminals are adapting to include crypto in their operations. And once we understand the crime itself and how we translate the criminal behaviors, then we can set up proper systems, proper policies and procedures that will help us flag these specific interactions. And this is doable because we see it with our customers, where they actually have their specific internal processes translated into transaction monitoring rules, whether it's source of funds rules or behavioral rules. And these transactions are flagged successfully. And we see a lot of customers that are able to hedge against that risk.
Yeah, definitely. People don't know what type of risk you can get from that. And obviously, it's not only regulatory risk. There are a lot of civil lawsuits that are going on right now, and demands to freeze funds, and obviously reputational risk as well for those companies. So that's something that I agree that they need to be more aware of, because the tools are out there and they need to be more knowledgeable about it and just to implement those tools. So before we wrap up, wanted to ask you, let's shift to a different region and talk about the US. And I want to ask you now, with President Trump arriving at the Oval Office and basically firing all the previous regulators, and starting from Gary Gensler and all the way through all the other agencies. So it's very evident that we're going to see a change, right? And especially when you have a president that has issued a meme coin, you can expect a change. But the question is, what type of a change we'll see? Because on one hand, he already promised, and again, with Elon Musk being at his right hand, they promised to be more lax with respect to crypto, and they want to attract funds that will come in, because the US was really lagging behind. But on the other hand, if there's so many crypto users in the US, we all know the tendencies, and at the end of the day, you need to regulate this, because many people will be unhappy, and the pressure is going to come, from the grassroots level. So what can we expect, let's say, during the next 2 years with respect to regulations in the US that will obviously affect the entire world?
Well, so I think that the main problem that the US had in the first place was obviously lack of this federal framework, because the companies navigating the space in the US had to make sense out of, patchwork of regulations, whether it was BSA, securities law, or commodities. So not having this specific federal framework made it very challenging for them to operate. And also, we saw the trend of regulation by enforcement, where companies found out about the boundaries of legitimate behavior only after they crossed the lines, but they didn't know what the line was before. And, it's quite sad for actual legitimate businesses, because they are really willing to abide by the rules, but they need to know what these rules are in the first place. So I think that this was the main issue that the US had, this regulation by enforcement and lack of clear legal rules. Because if you are a business, it's not that you don't want to comply with regulations, because most likely most of businesses will. They want to abide by the rules, but they need to know what these rules are in the first place. So we didn't have that in the US. And also because of that, we had this jurisdictional battles between different agencies, what we've seen with the SEC and CFTC. So I hope that with this new administration, we will see a complete change of how they are looking at crypto, because I think that they already noticed that they need this federal framework in place. And with the recent executive order and creating new crypto asset task force, it looks like we are slowly getting there. Obviously, the timeline is very optimistic, and I think it will still be pushed a bit. But we already see some proposals. We see a mix of Fit 21, of Genius Act coming up. So I think that US has really a good chance to come up with a federal framework, which is so much needed by the companies. I'm quite optimistic, and I think that the US can also learn from the experience that we've had here in the EU or other jurisdictions have, because they can actually see what worked well and what didn't work at all, and they can translate it into the rules in the US. So I also think that there is general difference in how the US is looking at crypto, because where us, meaning Europe, we see risks and something that we need to regulate very extensively, they actually see the opportunity. So I think that we can expect the federal framework this year that will be fairly balanced. This is my expectations. Obviously, how it will work out, we can never be sure. But seeing all the changes that happen across different agencies, executive order, first proposals, and first statements coming from commissioners, I'm quite optimistic that we will have these changes, at least some of them this year.
Yeah, and may I add, I think that we'll also see some regulatory arbitrage, right? Because different jurisdictions will have their own rules and their own frameworks. And that way,
Mhm.
crypto companies can choose where they want to be, where they want to set up shop. We saw that about 2 years ago with the UAE becoming a hub. Maybe the US will have its own, different way of doing that and competing with Europe and the UAE and Hong Kong and so on. So it's going to be interesting. That's for sure.
That's definitely the case. I also think that, with the MiCAR framework that we have in place, I still think that MiCAR is a big step forward, don't get me wrong. But there are so many provisions in this regulation that make the EU less attractive place to operate. So unsurprisingly, a lot of companies are looking at the US right now, because also in the US you have unmatched funding opportunities. So I think and liquidity as well because of the US USD dominance. So I think a lot of companies will look to set up their shop there instead of EU. And I just hope that EU will also step in because MiCAR obviously is a new regulation, so we are just learning about what the actual consequences are. But I think that with time, we will also have some tweaks to our regulation here in the EU to make it a bit more attractive, which is what I hope will happen. In the near future, I can tell that a lot of businesses are looking to relocate to the US and give up on a EU market share for that exact reason.
Agreed. So on that note, Natalia, thank you so much. Anything you want to say, where we can find more information, where we can follow your posts and your reports?
Well, I'm on LinkedIn, and if you would like to get more reports, obviously sign up with Merkle Science. We are also preparing US regulatory guide right now, so if you are interested in all things US, that's a good place to go. But yeah, other than that, just thank you for having me. It was really great to talk to you today.
Likewise. Thank you so much.
Thank you.
Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.